Receiving an almost 100% dividend yield on a single name stock sounds way too good to be true, right? These high yield ETFs are absolutely exploding everywhere, promising huge returns tied to some of the biggest name stocks that you've seen, like Tesla, Apple, Microsoft, and even DraftKings. But if they pay double and even sometimes triple-digit returns in dividend income, why isn't everyone rich and why isn't everyone investing in these things? Well, it comes down to the classic saying, if something is too good to be true, it is. This is one of them. Today we're breaking down how these high yield ETFs actually work and why they've become popular and more importantly, why it might be one of the dumbest investment decisions for your portfolio. So let's dive into this a little bit. These single stock high yield ETFs didn't just come out of nowhere. It's not like they're brand new or anything, but over these last, I'd say 2 years, they have exploded in popularity. And that's especially attributed to the rise of YieldMax, who is an ETF company promising high returns on single name stocks. Like, I know MSTY is a ticker that a lot of people talk about now, or TSLY, which is the Tesla one. There's a ton of them right now because they've had some incredible years. Their dividend income return on these high yield ETFs have been astronomical. And to anyone just quickly looking at it and saying, oh, I see 115% return was done last month for the dividend, that's like almost a no-brainer when you just see that number, but that's how they get you. And that's kind of the whole point that I want to talk about. So to really put things into perspective and just to start off this whole argument, these ETFs do not actually own the stock that they are based on at all. So when you're investing in one of these, you're not investing, like if you're buying TSLY, you're not investing in Tesla. You're investing in this ETF, which is using strategies we're about to get into. But look, I understand that may not be the biggest thing for everyone. Some people care about that more than others. But just so you know, that is red flag number one. So when you're buying a high yield ETF that says it's based on Tesla, it's not owning Tesla. It's using derivatives to do that. We're going to get into that now. Instead of owning this individual name directly, they're using a variety of derivatives to come up with that income or dividend yield that you receive. And I'm not going to touch on the idea or concept of contracts really at all. If you want to see that, definitely get subscribed to the channel. The quick rundown is a contract. If you're buying a call, it's essentially you're almost in a sense betting on the future growth of the stock. If you're buying a put, you're kind of betting on the future decline of the stock, but it's way more complicated than that. That's just a very simple way to look at that. Now, those two strategies are very basic derivatives. That's not exactly what YieldMax or any of these other high income ETFs directly use. They're using another form of these derivatives in the sense of selling a call or in general, just trying to create income from these call or put options. There's various ways to do that. Again, it's a topic for another video. All you need to know is they're essentially making their income on the contracts of like the side bet of the stock. Does that make any sense? That's a very simple way of explaining it. That's not exactly the one-to-one truth of the situation, but that's a very general idea. Essentially, it gives them synthetic exposure to the underlying stock. So I'm just using Tesla for an example. It would give underlying exposure to synthetic exposure to Tesla, and essentially that's like buying rent on the idea of owning a Tesla rather than buying the stock itself. So in order to make up that income, they're selling call options on the stock. Basically, in plain English, they're agreeing to cap their upside just so they could generate and collect that income so that they could pay it out for the sake of the high yield ETF. When they generate that income, that's called collecting a premium. And like I mentioned, those premiums get passed on to the investor in terms of that dividend income percentage that you receive. And that's that so-called high yield that we talk about. So yeah, the payout definitely looks amazing. And you may be even hearing this and saying, well, what's the big deal of that? Like, I don't need to buy this ETF to own the underlying. I'm buying this solely for the income. And I understand that way of thinking, but that's not where this whole thing just stops. Just because, oh, it's not real dividends, it's premium income. There's more to it, which we're about to get into. One of the things that I think is important to note, back to that point though, is while, yes, you may be looking at this and saying, oh, I want to buy this solely for that income, I'm going to use the income to then go buy SPY. You do need to understand the general concept before you even just sign up and buy one of these, that this is substituting potential growth of the underlying for short-term income, which some people may be fine with. But in general, most of the time, something like a Tesla has outperformed even these sort of numbers. Like if Tesla skyrockets, which it does have a tendency to do, you don't participate really at all because the ETF that you own sold the options income to pay you out, if that makes any sense. So while Tesla investors might double their money in a bull run, your high yield ETF could barely really move. Like, especially I'm talking about the underlying price, not necessarily just the dividend income. It's basically, you could think about it like renting out your profits to get short-term cash today. Again, it's, there's different flavors of ice cream for a reason, whatever floats your boat, but the reason I think this is so important to note is a lot of people want this so they could just generate the income on it. One of the most important things to remember when it comes to these as well is that it's really driven by volatility. We've had 2 years plus of an insane bull run lately, which is why these ETFs over these last 2 years have exploded in popularity. But when that volatility drops, your yield is going to drop significantly. And if the stock tanks, your principal tanks. So not only are you earning no income, but your stock itself, that high yield ETF, TSLY for instance, slowly starts to price erode to the point where you're not going to get your principal back. You're barely going to have a yield. And though we haven't seen that yet, there is a very high likelihood one day that will happen, because though a lot of people haven't seen a significant bear market lately, at least since COVID, it can happen. And if it does, you don't want to be holding the bag with these. Essentially, what a lot of investors see is they see that big number, right? They see the 114% yield on Tesla last month, but they don't think about the overall total return. Like, these funds might pay you, let's say it's 10%, but in reality, you're actually losing 15% in share value doing it. So while you are getting some income, you are losing the value of whatever you put into it. So you have to automatically, at least if you're okay with that, subtract however much you're buying of this by what your projected income is. But that's where it gets really risky, right? Because let's say you're okay with losing your principal. In theory, you invest, 100 shares into this, and let's say it's 114% right now. You're willing to lose whatever your total principal amount that you paid just to get that exposure. But then the next month, we have bad volatility, and the dividend itself only pays out like 8%. Is that really worth it when you could have been in the S&P, or you could have just been in the stock and buying the dip and eventually hold the bag for generational wealth to come? And that's the biggest thing, is price erosion in general, because they are not owning the underlying at all. And because this strategy is directly just selling options and paying out that income, the stock price, like the overall ETF price, is going to erode consistently downward. So you may have bought in at $15 per share. You hold it for a couple months, it's at $8 per share, and you're like, oh, I'll just wait to hold it until it goes up. That's not how these strategies work. As a matter of fact, you could find that information in the prospectus of these strategies. So it's not necessarily like, oh, it'll come back, it's like a market. No, it's not. You're using derivatives to get this underlying, to get this income, I should say, not the underlying. You're not holding the underlying. So there's no way it's going to appreciate in value. You're essentially eating your own capital just by holding this thing. And though, yeah, okay, maybe in a bull market you get some good dividends, this is a really risky play. And even if you see all this and you're like, yeah, I'm still cool with it, it then brings up the whole tax implications of this. If you're holding this in a regular brokerage account, you're gonna get screwed there. So if anything, and I don't agree with owning these, but if there's one place you should, it should probably be in an IRA, because if you're holding this in a brokerage, you're going to get taxed out the ass in short-term gains potentially, in return of capital, and it's just a nightmare. You don't want to do it. I'm not going to get into the whole taxing thing. Just look into it. It's a nightmare. All I will say is in my last line, I said short-term gains. It's not exactly the same essentially, because you're getting paid income. You're taxed at an ordinary income rate if you're holding that in a brokerage. That's not really that great. So when you factor in what you're getting taxed on it, mixed with the erosion of the stock itself and the total payout, if you factor all of that number in on a tax equivalent yield basis, you're not really looking at much. It's really not a good idea at all. But if you're going to hold it somewhere, it should not be in a brokerage account. At the end of the day, though, I might have made it sound a little bit like these are scams. They're not. They're legal. This is how ETF companies make money, especially because on a YieldMax ETF, the expense ratio is out the fucking wazoo. It's almost 1%. That's insane. That's insane on a stock. But what I'm getting at is it is not a scam. You could read all of this in the prospectus, but most people don't. It's just they look good on paper. And in the bull market, yes, if you hold it, you will get a good dividend income, but there's so much risk associated with it that for me, it's not even worth a consideration. I wouldn't put anything like this in my portfolio or anyone else's portfolio. Maybe there's something to say if you're loaded out of your mind and you don't give a shit about your principal and are going to hold this in a tax effective account like an IRA. Maybe then, but that's not most people who are buying these, if not really anyone buying these. But even then, it's not a good thing. I've been passionate on this topic for a while. I hope I explained it in a way that made sense to you guys. I'm gonna start posting more on here a lot, so definitely stay tuned for that. With all that out of the way, thank you again so much for watching this video. Be sure to subscribe if you haven't already, and until the next one, I'll talk to you later. Peace out.